Welcome back to the channel. I'm Ozbourne Foreman, and today I'm going to be talking about how to value a stock. And a lot of you already, especially those that like to follow my channel and take some joy out of the losses I have, for instance, they're going to go, well, hang on, you've not done that. So why would anyone listen to you at all? Well, I hope in that I've made a critical mistake in my valuation in the past, and I actually discovered a bit more about this recently. So I'd recently put money into my portfolio, as I do. I normally top up about £500 to £1,000 a month into my portfolio, basically as frequently as I'm paid, which is monthly. And I'd done that, and before buying, I was kind of instinctive, and I was going, oh yeah, I really want to top up and add some more shares of MasterCard this month. I think it's a defensive hold, it's a good company. And I kind of thought, well, the share price is relatively flat. This could be a decent time to buy and build up the position. And I realized in this moment that this is a bias that I've had possibly since the creation of the portfolio, in which I had done the analysis previously on each of the businesses in my portfolio. I would say I'm quite well versed in these companies. However, the issue lies wherein I wasn't taking attention or making detail of the actual valuation. So I was looking at these companies and going, yeah, I'd like to add some more MasterCard. It's a good quality company, but was disregarding valuation. So when I first analyzed the company, I would have gone, okay, yeah, price to earnings ratio of X, this is okay, I'll buy. But I then didn't look at it. I only looked at share price, which is something I was saying, don't just look at share price when investing. But that was exactly what I was doing. So it's quite amusing in that regard how easy it is to slip up. And so today, I've got 5 sort of questions I'm going to answer. And I think hopefully that people can learn from this and at least broaden your horizons in terms of valuation. And if you like this video, definitely drop one of these, as it is much appreciated. Sorry, I've proper knocked my thumb when I was doing boxing, and I think I hit incorrectly, so I jabbed with a thumb, and I shouldn't have done that. So hopefully that is definitely worthwhile dropping a like for my misery. So what is stock valuation, and why is it crucial for investors? Stock valuation is very important. I like to look at a company as if I'm buying a business, and I'm buying the entire business, much like Warren Buffett does. In that regard, you could buy a very, very high quality business, and this business could have, let's say £10 million a year they're making in sales, right? In terms of profitability, actually they're extremely profitable. Aside from tax, high profitability. There's literally no costs, no expenses, nothing like that, no labor or anything. So the profit of this company, let's say, is £8 million. That's a huge amount of earnings, right? And you'll go, wow, I'd love to own shares of that business. The sales are growing by, let's say, 20% per year. So next year it'll be 12 million in sales and let's say 9.6 million in earnings, something like that, right? And then you're looking at it and going, wow, this is a phenomenal business. I really want a share of this. However, and you could say, well, this could be a good investment. They've got competitive advantages. I've looked at the business itself. This is advantageous. I think I could buy this and this will grow over the longer term. However, the concern overall with this is actually the price you're paying for it. Now, this company could be valued at, let's say, 20 or 30 million pounds, or alternatively, I could be going, I really want to buy shares of this company. It's got, nearly 10 million pounds in earnings, in profits, but actually it's valued at 200 or 300 million pounds, meaning that I'm paying quite a premium for the earnings in this company. Because investors anticipate so much growth in the future, people are willing to pay a premium for this, which presents risk, because if the financials of this company slip up and suddenly the expected 20% growth per year of their total sales or revenue doesn't get hit, then the valuation gets smashed and it falls straight through the cracks, which is where I relate to what I was doing. So I was looking to buy more shares of MasterCard, and the valuation was sitting at a whopping 36 times price to earnings ratio, which we'll cover a bit more later. And realistically, if, let's say, MasterCard had a very disappointing earnings update and actually Visa's taking more market share for whatever reason, MasterCard's valuation is probably going to take quite a substantial hit. At which point, obviously, not only have I bought up at a higher price, I've now taken a hit, potentially a loss, and I'd probably have to consider selling based on the fundamentals of the company. So it is crucial that investors take care and note of valuations, because I think it's primarily the best way to either make or lose money And you need to find a good valuation because it's easy to identify good companies, but to identify a good price for a good company, I think is far more challenging. And I probably think that's the hurdle that most investors trip up on and why 80% of individual stock pickers do not outperform the markets. So the other day, I was looking at Rightmove, right? And I'm doing a stock watch report on this. Well, I've done it. It's now available on my Patreon. And I was going, this is actually a cracking company. They've got a fantastic business model. Sure, it's digital only, and I suppose there's no real barriers to entry in the industry, but their margins were phenomenal. And I thought, you know what, this is a good business. I'd love to have a slice of this business and own some of it for the future. And before I did, I kind of sat down and went, okay, but what is the valuation of the company? What do I think of this? And actually, if you look at, let's say, some of the quick metrics you could look at, like let's say price to book, price to sales, we'll talk about that later, it was very premium. So it's coming back to that and going, I found a good quality company here, potentially. Although you could argue, and I did write about this in my Patreon report, and there's a link in the description for this report, and I did argue that actually they have an over dependency on estate agents and they keep hiking up fees, whilst they have a very controlling market share for now. There's still room for a competitor to come in and really dig into that and really disrupt the market share. So what are the key factors to consider when valuing a stock? What is most important? I think really the most important factor to look at is earnings and cash flow. By looking at the earnings of a business, you can identify, especially if it's more predictable, more stable, that's how much you're likely going to receive as a potential dividend if all of it was paid as a dividend. Let's just assume that. Meaning that's how much money is being almost paid back to you. So typically a lot of companies, for instance, that are more mature and don't necessarily reinvest in their own operations, they'll chuck out a load of money in dividends from their profits and a load of money in share buybacks. This can generate a lot of returns for a shareholder, and that's great because they're buying back shares, reducing the number available in the pool, and they're also paying out a chunky dividend, which is great. So I think realistically, investors are going to be looking for earnings and cash flow here. And I'd probably also look at the balance sheet, because if you've got a declining balance sheet, which I discussed with Rightmove, Rightmove has had zero debt, which is great. What a great business position to be in, but their assets and their equity over time had been falling. So the valuation based on the value of the books was actually decreasing over time, which isn't really generating shareholder value. For instance, if we were to invest in, say, gold, right? Gold is an asset. It's likely to hold its value, but it's not a productive asset. It's not producing anything. It's not like a business that has, £1 billion in sales per year selling pints, right? That's producing cash flow. Gold isn't. And in that regard, it's kind of crucial that we need to look at the balance sheet as well, because let's say the company is selling more pints, but the value of the company is for some reason decreasing at quite an alarming rate. Well, there's less value for shareholders there. Let's say the property portfolio of the company, which is unlikely if you're in the UK, is falling significantly. Well, that's a concern. You're now buying less of the total price of the company in terms of what they've got on the books. So the important thing is, what are the different valuation methods and how do they work? I've got a good article here. Let's skip this part here. Good article here. And this is on Investopedia. I'll put a link in the description down below. And it says there's two categories of valuation models. You have absolute valuation. These attempt to find the intrinsic or true value of an investment based only on fundamentals. Looking at fundamentals simply means you would focus on things such as dividends, cash flow, and the growth rate for a single company and not worry about any other companies. Valuation models that fall into this category include the dividend discount model, discounted cash flow model, residual income model, and asset-based model. Now, this is something that I have most certainly neglected in my valuation process. I found it very hard to find the true or intrinsic value of a business. I thought, how can I quantify the value of a share? I personally found it quite easy to identify a high quality company. Again, the irony in the fact that my largest position was Boohoo, which arguably you could say isn't a high quality company. That's fair. But I do find it, in my opinion, I think most people can spot a good quality company, but it's that good price for it. And that's where it's critical that absolute valuation also takes some place in, obviously, your investment strategy. I've got about 4 dogs across the road barking like mad, so I hope this doesn't interrupt the audio too badly. I think the neighbours are about to have a domestic, actually, so Who knows? I'll keep you updated. Anyway, so relative valuation models, in contrast, operate by comparing the company in question to other similar companies. These methods involve calculating multiples and ratios, such as the price to earnings ratio, and comparing them to multiples of similar companies. For example, if the price to earnings ratio of a company is lower than the price to earnings ratio of a comparable company, the original company might be considered undervalued. Typically, the relative valuation model is a lot easier and quicker to calculate than the absolute valuation model, which is why many investors and analysts begin their analysis with this model. Now, I, in a way, was quite foolish, and this is why, let's say, a common pitfall to avoid when valuing stocks is that I only used relative valuation models, and even then, it was kind of hard to quantify a true value for the business. For example, if I was looking at a price to earnings ratio of a certain stock, let's say we're looking at MasterCard, okay? And MasterCard's price to earnings ratio was 20 times. How would I know what times multiple was a good valuation? Well, you could say, oh, well, the S&P average at the moment is 15 times. Therefore, it's a slight premium to the overall market. Okay, that's cool, but it still doesn't help me identify a price. It's kind of a quick way of identifying. And Peter Lynch's rule here, reading from the One Up on Wall Street, those dogs are still going. I really hope that this hasn't interrupted this. But One Up on Wall Street, for instance, here, one of his rules is that he says, if a business is growing at 20% earnings per year and the price to earnings ratio is 20 or less, then it is a good value. This is called a price to earnings growth ratio. And I tried to look for this, but I found that it was very limited in that it was a snapshot in time. If you're looking at the last 12 months, then obviously, right, hang on, sorry, I've got to close the window there. Sorry about that. I never, ever stop and cut out a video, but those dogs are just uncontrollable. And the neighbours just kind of sat there not doing anything about it at all. But it is a Saturday, so it is what it is. What I was saying here is that if the price to earnings growth rate is quite limited in a regard because it's a snapshot. If we're looking at the last 12 months and we're identifying, okay, in the last 12 months, the company made this much in earnings, but is it going to make that going forward? Is the earnings going to grow at a solid 20%, or actually is it less predictable? So it's very good in a snapshot, as discussed, to identify this, but realistically it's limited. And I actually found myself kind of just going, yeah, if it's 25, 30, oh, it's 40 times, but everything else in the market is about 40 times. This is a good valuation. This doesn't consider the impact of, let's say, when it was the pandemic and we had stocks trading at ridiculously high multiples. It's kind of hard to realize, oh, wait, hang on, they're significantly overvalued here if you're a new investor, because you don't really know what that standard is for a price to earnings ratio. But it is a very useful method if you say, look at a company and go, okay, MasterCard is trading at 37 times price to earnings. This indicates that an investor is willing to pay a premium for the earnings in the business. The investor likely has high anticipation over the growth of the earnings, or they believe that the company has a very strong business model and a wide moat. Again, we can look at a very similar thing with sales. If the price to sales ratio is very, very low, well, this indicates that investors aren't that keen on the revenue. They don't think that the revenue is that important. They might be fixated more on earnings. So they might have actually, in this regard, they just don't value the sales in the business. They don't think that it's of a good quality. And it might suggest that the business model itself is in a fickle industry, is in an industry where maybe it's not interesting or worth buying into, hence why it's brought down into line. And you've also got price to book, which I think gets confusing quite quickly, although arguably is probably one of the most important of these relative valuation models, in that you can look at the assets on the balance sheet, deduct your liabilities and say this is how much it's worth. But when you start looking at dividend companies, this is where it gets a bit more complicated. And it kind of disregards this because the dividend is getting paid out. They lose that money from the book value of the company. Same with, well, share buybacks is a bit different in that regard, but it becomes difficult in that way. So I think really, the kind of financial statements or the strategies and ratios to help determine a value of a stock is going to be your absolute valuation models. I think as a comparison, it's great to be doing the relative valuations, your price to earnings, checking it versus competitors. But to actually find an intrinsic value of a company, I've moved on to the idea that I'm going to start looking at discounted cash flow. Now, I'm just going to gloss over the dividend discount model, so it's one of the most basic absolute valuation methods. The dividend discount model calculates the true value of a firm based on the dividend the company pays to its shareholders. The justification for using dividends to value a company is that dividends represent the actual cash flows going to the shareholder, so valuing the present value of these cash flows should give you a value for how much the shares should be worth. And the first step is to identify if the company pays a dividend. Then it identifies if it's stable and predictable, since it's not enough for a company to just pay a dividend. Okay, so it's valuing very much a dividend. You could argue dividends are irrelevant and that for most companies it might be better off reinvesting back in the business unless they're significantly large and aren't able to grow. But I personally believe that if a company is chucking off enough cash flow, then it should be possible that business should be able to either reinvest in themselves and try and grow organically, or look for acquisitions, buying companies that are struggling a bit and turning them around and making them heavily profitable. So the valuation method I'm interested in particular is the discounted cash flow model. And I haven't quite set up a model yet, but I'm trying to build on Excel a spreadsheet that can do this for me. It does require quite a bit of work because you've got to identify things like the earnings before interest and taxes, the cash flow, you've got to work out the equity, the enterprise value, and you've got to work out a lot of different formulas. You have to plug in a lot of manual data, but I do think that it will find you a better indication of the value of the business in that time period. And that way, when we use this approach, we can almost go, okay, you know what? Boohoo's trading at 45 pence a share. Intrinsically, I think it's valued at 53 pence a share. Let's add a margin of safety of 10% onto that. Well, actually, if the shares are 47 pence or lower, it could be a good opportunity to buy. Well, what about the future outlook? And it looks and it discusses the growth of the cash flow, for instance. And you can go, well, the industry is growing at X% per year. Therefore, Boohoo, let's say, might grow a little bit more than the industry. So what you'll say is, and you will discount that over time, right? Because the value of money now is worth more than the value of money in 10 years' time, hence why it's called discounted cash flow. And it says, what if the company doesn't pay a dividend or its dividend pattern is irregular? In this case, move on to check if the company fits the criteria to use the discounted cash flow model. Instead of looking at dividends, the DCF model uses the firm's discounted future cash flows to value a business. The big advantage of this approach is that it can be used in a wide variety of firms that don't pay dividends, and even for companies that do pay dividends, such as company XYZ in the previous example. I didn't need to read that bit. It has several variations. The most commonly used is the two-stage DCF model. In this variation, the free cash flows are generally forecasted for about 5 to 10 years. Typically, a company that's more stable and predictable in cash flows will be a 5-year model, whereas a business that may be a bit more volatile is more of a 10-year model. A terminal value is calculated to account for all cash flows beyond the forecasted period. This is basically saying, okay, this is the sum of all of the money that you expect to make beyond that time period. And that adds a part of your valuation here, because the business after 10 years isn't just going to shut down. It then says the first requirement for using this model is the company has to have positive and predictable free cash flows. Based on this requirement alone, you'll find that many small high growth companies and non-mature firms will be excluded due to the large capital expenditures these companies typically encounter. That right there, I think, is an absolute snippet of gold here. I think it is very risky to be invested in companies that do not have a positive free cash flow. That could even be a golden rule. Just don't buy a company that doesn't have a positive free cash flow because they haven't got a proven track record. Again, this could be, I might miss out on these opportunities that are discussed, these hype stocks, right? These IPO'd stocks that have just raised money. I might miss out on those opportunities. But if I can find more predictable and I can find companies that actually have a positive free cash flow, then I think I'd be looking at, let's say, less of a risk, but a more consistent reward, which I think is what's more important here. And therefore, I think really, this model is the most important. I think that's where each investor should come away from this video and go, okay, I've not been valuing stocks correctly. I've only been looking at things like price to earnings ratios. Now it's time to get stuck in, look at discounted cash flow models and do better. For instance, if we look at my portfolio, look at how much I'm down. I'm down at 17,000. I'm going to round that up to £500. I've managed to save and invest £41,000 at my age. I'm 23 years old. However, I've made a mistake because I didn't value companies properly and I had poor risk management. But the valuation of the company is why obviously I'm down a significant amount. I've now lost half of those savings. I could have bought quite a respectable house or a mortgage. I don't truly believe in that, but we won't get into that in this video. And I could have had that available. Or alternatively, I could have invested that back into my online business and chucked off a significant amount of cash flow due to the investments. But instead, what I did is I bought very pricey companies with little thought or care into the actual valuation of the business, and therefore I suffered large losses. I do believe I can drag this one back, and I think that over time, my strategy is going to keep improving. The aggregation of marginal gains, like from the Sky Cycling team. The idea here that if I constantly look at myself, my own bias, and what's going well, and then identify where can I improve, even if I have to improve by a small amount today. Even if it's 1% per day, over the course of a year, you'd be a completely changed person. If I can identify something small, improve that process, and do slightly better, then hopefully over the longer term, I can generate substantial returns that justify investing in individual stocks and shares rather than that of index trackers. So I hope you enjoyed today's video. It's been a long one. Thank you for watching. And if you haven't already, definitely go check out my Stockwatch reports available on the Patreon. I'm going to be doing a community poll soon. I'm going to be doing one for free as a proof of work. So keep an eye out for those polls. There's a handful of companies that are going to get involved here, and I picked quite a few popular ones, but we'll see what will happen. But anyway, have a fantastic day.